You hear that? Stock prices have reached what looks like a permanently high plateau. That was said by Irving Fisher, probably the most respected economist of his time, in October of 1929. Yeah, just weeks before the whole thing completely fell apart. It's a pretty sobering reminder, right? It shows how even the absolute smartest people can get caught up in the madness right at the top.
So that begs the question, what if that same playbook, the one from 1929, is happening all over again right under our noses? Well, today, we're going to dig into an analysis that suggests there might be a 90-day warning signal flashing for the markets right now. And the whole idea here is based on that old saying, history doesn't repeat, but man does it rhyme. And when you start lining things up, you see some truly uncanny, almost terrifying parallels between the Roaring '20s and, well, right now. I mean, just look at this. Back in the 20s, you had revolutionary tech like the radio and the automobile changing the world. Today, it's all about artificial intelligence. The retail investor mania has just changed costumes. It's gone from shoeshine boys giving stock tips to Reddit forums pumping stocks. And the superstar stock of the era, RCA, has its modern-day equivalent in NVIDIA. It's the exact same human behavior, just a century later. And all of this leads to what's known as the melt-up. You know, that last crazy, euphoric surge right before the floor gives out. In the summer of 1929, the market rocketed up almost 30% in just a few months. It's like the market's final cruel trick designed to suck in every last skeptic and get them fully invested right before the party ends.
So where's the countdown clock? Where's the signal? Well, according to this playbook, if you're just staring at stock prices, you're looking in the completely wrong place. The real warning, the one that actually starts the timer, is hidden away in the bond market.
Okay, so let's get right to it. What exactly is this 90-day warning? What is the one signal we should all be watching?
It all boils down to this thing called the yield curve. Now, put simply, it's just the difference between the interest rate on a short-term government bond versus a long-term one. Think of it as the economy's vital signs. Normally, you get paid more to loan your money out for longer. But every now and then, that whole relationship gets turned upside down.
And here's the twist that almost everyone misses. Step 1 is the warning sign. The yield curve inverts. That means short-term rates are actually higher than long-term rates. This has happened before every single modern recession. But that's not the crash. The crash comes after the Fed panics and starts cutting interest rates, which causes the curve to uninvert and go back to normal. That steepening, that return to normal, that is the real signal the system is about to break.
And this isn't just a theory. The historical pattern is crystal clear. Back in 1929, the curve uninverted just a few weeks before the big crash. In 2008, it happened right before Lehman Brothers went under. And the key takeaway here, right now in 2026, the curve is doing that exact same thing. It's steepening its way back toward positive territory. So if the yield curve is the smoke detector that's blaring, what's the actual fire? Well, this analysis argues it's a hidden fuse that's burning away in two specific corners of the market: commercial real estate and the shadowy world of private credit.
Which makes you ask a really important question. If the Fed is starting to panic and getting ready to cut rates, what are they seeing behind the curtain that maybe the rest of us can't?
They're seeing this number, $1.8 trillion. That's how much commercial real estate debt is about to hit a maturity wall in 2026. These are loans that were taken out when interest rates were near zero, and now they have to be refinanced at rates that are double, maybe even triple what they were before.
The math here is, well, it's just brutal. Get this, the National Bureau of Economic Research says that a staggering 44% of all office loans are already underwater. That means the building itself is worth less than the loan on it. The owners have literally zero financial incentive to keep paying.
So who's left holding the bag on all these bad loans? It's not the giant, too-big-to-fail banks. Nope. An insane 70% of this super risky debt is sitting on the books of small and mid-sized regional banks. For a lot of these banks, this isn't just a problem. It's a potential wipeout event just waiting to happen. But then there's the other part of the fuse, and it might be even more dangerous: private credit. You can think of these as the modern shadow banks. They've exploded into a $2 trillion industry, making risky loans to companies that can't get money from regular banks. And it's all happening completely out of the public eye. And here is the fatal flaw, the ticking time bomb in this market. In the public markets, assets are marked to market. Their value is updated constantly, in real time. But in private credit, the assets are marked to myth. Their value is whatever the fund manager decides it is. This creates a huge incentive to just hide the losses and pretend everything is fine until it's not. That whole illusion comes crashing down with something called the gating event. This is the moment a big private fund, which has been hiding its losses, suddenly has to suspend redemptions. Investors who try to pull their money out are told, sorry, the gate is closed. And that's the trigger. That's when all the hidden rot from the private markets suddenly spills out into the public markets. Okay, so this brings us to the final act of the playbook, and maybe the most shocking part. The claim is that the aftermath of this crash is not going to look like the 1930s. It's not going to be a deflationary depression. It's going to be something very, very different. You see, the Federal Reserve and the government will be backed into a corner with only two choices. Option A, they let the whole system collapse into a deflationary depression just like the 1930s. Or option B, they fire up the money printers and print whatever it takes to bail out everybody and everything. In other words, they sacrifice the currency to save the debt. This playbook is absolutely convinced they will always choose option B. And that decision kicks off this really bizarre, dangerous phase called the crack-up boom. It's a boom where stocks and other assets go through the roof, not because the economy is healthy, but because people are absolutely terrified of holding a currency that is being systematically destroyed. This quote from the source just nails the psychology perfectly. You buy the S&P 500 not because you love Apple's earnings, but because the dollar is a melting ice cube. The goal isn't to get a return on your capital anymore, it's just to get a return of your capital from the fire of inflation. But see, this whole thing is a trap. It creates this illusion of wealth because your stock portfolio is going up. But in reality, it's gutting the true value of cash, of savings accounts, of the pensions held by the middle class. The gap between the rich and everyone else explodes, and that can lead to some really intense social and political chaos. And that leads us to the playbook's final trap. Imagine you're in a burning building, right? The currency is the fire. You realize what's happening, and you try to run for the exits, maybe buy some gold, move money to another country. The predicted response from the government will be to lock those exits. Which leaves us with one final, kind of chilling question. The math of too much debt and too much leverage, it always works itself out in the end. That's like a law of financial physics. The only real question, the only variable, is who gets left holding the bag when the music finally stops.